Welcome to this explainer. Today, we're diving into a highly requested guide on how to escape that daily grind and actually build a reliable, get-rich-slowly income system. We're going to completely reframe how you think about earning a living. So if you're feeling exhausted by that endless cycle of working, getting paid, and spending, well, you're exactly where you need to be.
I want you to think about your current situation for a second. Whether you're a market trader in Lagos, a civil servant in Abuja, or, just an everyday worker anywhere in the world, most of us earn our living the exact same way. We're trading our time for money. We work, we get paid, we spend that money on living expenses, and then, boom, we wake up and repeat the whole shebang the very next month. It's an exhausting treadmill, right? But what if there was a way to break that cycle? What if you could build a system where cash just keeps flowing into your account whether you're working, sleeping, traveling, or just hanging out with your family? That is the absolutely life-changing alternative of making your money work for you.
Okay, let's dive right into this mindset shift in Section 1, escaping the income cycle from labor to ownership. You see, the biggest hurdle to building wealth isn't always about how much money you make. It's a fundamental mindset shift. We need to move from relying purely on the labor of our own two hands to the incredible power of ownership. To really get this, let's look at our core concept, the dividend. Simply put, a dividend is a payment made by a company to its shareholders from its profits. Imagine you own a small neighborhood provision store. Every month, after all the expenses are paid off, the store makes a profit. And as the owner, you take a share of that profit home. That is exactly what dividend investing is. When you buy a stock, you aren't just buying some random ticker symbol on a screen or taking a gamble. No way. You are buying a piece of a real business. You literally become a part owner. And when that business succeeds and has excess cash, it actually rewards you for your trust by sharing a portion of those profits directly with you.
So the absolutely crucial point here is understanding the difference between income and wealth, because a high salary definitely does not equal wealth. Take a look at person A. They earn a fantastic salary of 500,000 naira a month. But they spend 500,000 naira a month. Their net wealth growth? Absolute zero. If they stop working, the money completely stops. Now look at person B. They earn half as much, 250,000 naira, but they diligently invest 50,000 naira every single month into dividend-paying stocks. Person B's net wealth is actually growing. Over time, person B will become wealthier because true wealth comes from owning income-producing assets, regardless of the salary you start out with.
Which brings us to Section 2, the compounding wealth engine and the snowball effect of reinvestment.
So how does person B's wealth actually grow so much? Well, it grows through Albert Einstein's favorite financial force, compounding. Compounding is basically when your investment returns start generating their own returns. Imagine planting a single seed. That seed grows into a tree, right? Then that tree produces fruits with more seeds, which fall and grow into even more trees. Eventually, your one single seed has grown into a massive, self-sustaining forest. And the water and sunlight making that forest grow, that's time. Time is your absolute greatest asset in dividend investing. It's really not about having millions of dollars today. It's all about consistency. If you commit to a 15-year strategy of simply investing and reinvesting a steady 6% dividend yield, that is where the magic of compounding truly accelerates and just takes on a life of its own.
Let's actually map out how this timeline plays out. In year one, your returns might look kind of tiny, maybe just 6,000 naira in dividends for the entire year. I know, it feels incredibly slow, but instead of spending it, you reinvest it. By year 5, you own more shares, so your dividend payout increases. By year 10, the growth is noticeably faster. And by year 15, you're experiencing an extraordinary, exponential increase in passive income. It is exactly like rolling a small snowball down a long hill. At first, it barely gathers any snow, but as it gains momentum, boom, it becomes massive.
But to get that snowball rolling, you have to choose what kind of investor you're going to be. Are you the consumer investor who receives a dividend and immediately blows it on a nice dinner they'll completely forget about by tomorrow morning? If you do that, your portfolio growth is going to remain stubbornly slow. Or are you the builder investor? The builder takes every single dividend and immediately reinvests it to buy more shares. I strongly advise you to adopt this builder mindset. Think of every single share you own as a little worker. When you reinvest your dividends, you're basically taking the money your workers made for you and using it to hire more workers.
All right, Section 3, finding great dividend stocks and building your beginner-friendly portfolio.
So how do we actually go about hiring these workers? Well, finding great dividend stocks isn't about predicting the next massive tech boom or picking the hottest, trendiest stock on social media. For a beginner, the goal is to find 5 to 10 strong, stable companies that sell essential products people use every single day. You want to diversify to protect your wealth, and this brilliantly illustrates how to do that. Imagine spreading your investments evenly across 5 essential pillars. 20% in banking, 20% in consumer goods like food and household stuff, 20% in telecommunications, 20% in healthcare, and 20% in utilities and energy. By spreading your money across these everyday essential industries, you're protecting the whole shebang. If one sector faces an economic downturn, the other 4 are right there to make sure your dividend checks keep arriving on time.
Let's move on to Section 4, avoiding beginner investor mistakes and protecting your wealth from common traps.
Look, dividend investing is simple, but it's not always easy. Honestly, a lot of beginners destroy their wealth before compounding even has a chance to work its magic, mostly because they fall into emotional traps and bad habits. Let's protect your hard-earned wealth by keeping a very close eye out for these critical red flags. You want to avoid companies with consistently declining profits or a history of irregular or missed dividend payments. Definitely be wary of businesses carrying excessive debt. And when it comes to your own behavior, please do not fail to diversify. And above all, do not panic sell during a market drop. A drop in stock price is completely normal market behavior. Actually, scratch that. It's expected. A declining underlying business is the real danger, not a fluctuating stock chart.
But of all the mistakes out there, chasing exceptionally high yields is for sure the biggest trap of all. As a beginner, it is so tempting to see a stock offering a 20% or 30% dividend yield and think, wow, I've struck gold. Well, you haven't. A 20% yield usually means the stock price is plummeting because the company is in serious financial trouble. Chasing these sky-high yields almost always leads to slashed dividends and lost capital. Don't do it. Instead, you really want to focus on a sustainable, boring, yet incredibly reliable 5% to 8% yield from a rock-solid company. Which leads us nicely to Section 5, your path to freedom and creating a monthly income system.
Let's move to this and see how it all builds together. When you stick to those reliable companies, something incredible happens. You start building your path to true financial freedom. Because companies pay out their dividends on different schedules, you can strategically buy stocks that pay in different months. Say, Company A pays in January, April, and July. Company B pays in February, May, and August. And Company C pays in March, June, and September. Combine them, and suddenly, you have a calendar of steady, year-round, monthly income arriving right in your account. This is a journey through 4 distinct phases. Phase 1 is awareness. That's exactly what you're doing right now, learning the strategy. Phase 2 is foundation, where you build that crucial habit of consistently investing small amounts. Phase 3 is expansion, where you're rigorously reinvesting those dividends to grow your portfolio rapidly. And finally, Phase 4, freedom. Now this takes years of patience, but Phase 4 is the absolute holy grail, where your dividend income finally covers your actual living expenses. You're financially independent.
This brings us to the core philosophy of this entire explainer. Wealth is built when money works longer than you do. Just think about that for a second. True financial security isn't about working harder. It's not about working longer hours. It is about finally severing that link between your time and your income. It's about turning your money into a tireless workforce that never sleeps, never takes a vacation, and literally never stops earning for you.
So I leave you with this provocative question. When will you start building your system? Remember, your absolute greatest asset in this journey isn't some massive pile of cash. It's time. And every single day you wait is a day of compounding growth lost forever. The system is simple, the rules are clear, and the path to freedom is right there in front of you. So what's stopping you from taking your very first step today?